we had GDP data, we had inflation data, and all that data started to show stagflation. So, that's the big bugaboo for the Fed, and of course, yesterday, Jerome Powell said, I don't see any stagflation. Of course, what's he going to say? I see stagflation like the 70s, even though that's what we're starting to see. He's not going to say that. I mean, if you take a look at the GDP number, it was 1.6%. And the CPI inflation rate is nearly 4%. It's only a matter of time to where the gold price finally ends this consolidation and goes up towards its next target, which is $3,000 an ounce.
Hello and welcome back to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the @JR Mining Guy on Twitter and the CEO of the Soar Financially Group. Truly appreciate you joining us here for a phenomenal conversation, because we're bringing somebody back that we haven't had on the channel for over 2 years, I believe. And I have no idea why we neglected that, because he's a good friend of ours. We love chatting with him. It's David Erfle. He's the Junior Miner Junky with the Y, and we have so much to discuss. Lots going on. And he's somebody also we can talk about the big companies. A sector I don't follow too closely. Of course, I watch what Newmont and Barrick and Agnico are doing, but I don't follow them on a daily basis. He has better insights there, and we're going to talk about their numbers. Q1 numbers just came out, and I'm personally hoping that it is a bit of trigger for the sector, that we can see, or I'm suspecting that we can see maybe some more free cash flow being added to the balance sheets, and maybe that triggers a bit of an M&A rally. We'll see. A lot of speculation. Some of the questions I will definitely ask David. Before I switch over to my guest, quick reminder, hit that subscribe button. It helps us tremendously get more visibility on YouTube, reach the right audience, and of course, educate and tell a good story. Keep in mind that none of this today is investment advice. We will be talking about some single stocks, but again, not investment advice. Do your due diligence. We're trying to get a sense of where things are headed. We're trading at over $2,300 an ounce for gold. Why haven't the stocks really moved? So we're going to get to the bottom of this. And now, without much further ado, David, it is great to have you on the show. Thank you so much for joining me. It's been way too long.
Yes, always great to talk to you, Kai. Yeah, thanks again for having me on. I know it's been a while, but I've been looking forward to it too.
Same here. Your highlight of my week. We're getting ready here in Frankfurt for Deutsche Goldmesse, but this conversation, I always enjoy chatting with you wherever we see each other at conferences, and definitely value your opinion, because one thing that separates you from other newsletter writers, you invest your own money. You have to generate a return to make a living, and we'll get to like how you're doing that in a second. But let's zoom out first. Like, what does the world look like, David? How strong is the economy, and what is really driving gold?
Yeah, that's the big picture we have to look at here, right? I mean, if you take a look at what was going on into the end of Q1, the gold price was bottoming around $2,000 an ounce, and the stock market was peaking. So that and just as we went into Q2, the stock market rolled over and the gold price started to take off. So this is what we've been waiting for, is for the gold price to get stronger, is the stock market rolling over. But you also have that geopolitical component as well. When things in the Middle East started to heat up, that's when gold really started to take off. So the gold price moved $450 in the space of 2.5 months. And within that move, you had a breakout of a 13-year cup and handle. We've had that, the gold price was trying to get above that $2,000 price level for 13 years. And then when it finally did, we had that strong move. And it was mostly driven by geopolitics, but you also had the Fed debt situation come into focus. So you had this perfect storm for the gold price. You had the geopolitical, you had the macro, and then you had the technical of a 13-year cup and handle breakout. That was very powerful. So the gold price ran up almost to 2,500, which is the initial cup and handle target. And now we're into consolidation. I mean, this is a healthy consolidation. When the price of anything moves that far, that fast, you need a healthy consolidation. And that consolidation right now is happening within $150. It's the gold price is trying to bottom around 2,300.
Yeah, I was going to say, like, I'm just looking at it, 2303. It's extremely steady. It dipped below 2,300 briefly the other day, I think 2 days ago, but it's holding in there. Like, the question is, what is holding it there? And you mentioned three drivers for the gold price, and I'm curious which one is the main one that is pushing gold to those levels or holding it at the levels: geopolitics, the Fed, or I didn't write the third one down. Geopolitics, Fed,
technical,
and the technical part, the cup and
right.
handle breakout, right? So
Right.
which one is like, if you were to give percentages, which one is the most important?
Well, most important is the macro, but I think what was driving it mostly towards that 2,500 level was the geopolitical. And then when things calmed down, that's when you saw the gold price start to correct, and then everyone was starting to focus on the macro because we had the Federal Reserve meeting coming up, we had GDP data, we had inflation data, and all that data started to show stagflation. So, that's the big bugaboo for the Fed, and of course, yesterday, Jerome Powell said, I don't see any stagflation. Of course, what's he going to say? I see stagflation like the 70s, even though that's what we're starting to see. He's not going to say that. I mean, if you take a look at the GDP number, it was 1.6%. And the CPI inflation rate is nearly 4%. That's twice the Fed's fantasy target of 2%. And then its preferred inflation number, PCE inflation, is around 3%. So and now the third major component of stagflation is jobs, right? And now we get the jobs report coming out Friday. So we had a lot going on this week. It's brought a lot of volatility into the gold price. It's brought a lot of volatility into the stock market, which continues to roll over. We had the S&P 500 lose its 50-day moving average last week, come down to close to near 5,000, and if it gets below 4,900, that will signal a bear market, I think, because once you see that 50-day moving average is now resistance, we've seen a back test of that, and now it's the 18-day moving average which is providing resistance, and that's sharply moving lower now. And if you look at the 18-week moving average, that's where the S&P is at right now. So you see AI stocks showing cracks. The Magnificent Seven is no longer Magnificent Seven; it's Magnificent Four. And we all know they're priced for perfection, and they've got bubble valuations. They're starting to roll over. Bitcoin has lost 60,000. So all these are creating a bullish picture for the gold price to go higher once this consolidation is over.
I fully agree. Lots of really good reasons for gold to hang in there. And I'm just looking at the main markets, and I'm trying to understand, like, how do I phrase that, David? It's like, I need to cut that part. No, I had a good question lined up. Like,
that's what edits are for, right?
Oh, absolutely. It's like, no, it was like a bit all over the place today. No, David, those are very great, fantastic reasons for gold to hang in there. The question, though, is, do you see a correction maybe down to 2150, or how do you see that current correction phase sort of play out for gold? Because it has been a massive move higher, and backfilling that gap might make sense. The question is, how far do we have to backfill?
Yeah, well, if you take a look at gold's 50-day moving average, which is sharply rising now, it's getting close to that 2250 level. So I wouldn't be surprised if you see a fantastic on the surface jobs report number tomorrow. We could get algorithmic based trades sending the gold price below 2,300 towards that 2250 area, because we know that all these major announcements by the Fed are set up with computer-based trades. So this is why it's very important to basically step aside and wait to see what the fallout is after it's happened. Because if it's a fantastic number, then these algorithmic trades are set to sell a strong number, and then real investors come back in after sifting through the numbers. Because if we take a look at the last jobs number, which was a blowout number, right? Most of those jobs that were created by the government, and a lot of people now are finding it really hard to make ends meet. So they're working 2 or 3 jobs to keep up with inflation and rising prices. So these government jobs don't create GDP, and that's why you're seeing the GDP numbers lower, even though the jobs numbers are higher, because public public jobs don't create GDP. And you saw reports come out this week. You saw manufacturing jobs are not being created. That's 10% of the economy right there. So if you look under the hood of these jobs reports, they're not as rosy as they seem.
No, they're definitely not. And the government reports, like, I think I looked at one quote. I didn't look at detail. I think 190,000 jobs were created. 80,000 of them were government jobs. Like, how is that reality?
Exactly.
Right.
Exactly.
Definitely. David, I want to just explore the term stagflation with you a bit more and the impact on the gold price. Like, what does that really mean? Stagflation, I think, is, a slowing economy and rising inflation. I think we have to lift the skirt a little bit and just try to understand, like, okay, is the economy really slowing, and why is inflation increasing right now? And what is the impact on gold?
Yes, I mean, stagflation is basically slowing growth in a sticky rising inflation environment. And if I was alive back in the 70s to experience stagflation. I was a child, but still I experienced it, and it's not a lot of fun. So if you compare what happened back in the 70s to what's happening now, the inflation was created by the Vietnam War, right? So all of a sudden, you've got this stagflationary environment, and you got the Federal Reserve who had to raise interest rates up to 20%, and the gold price rose right along with the interest rates because of this stagflation. And you had the oil price going crazy because of what was going on in Iran. So, and then you had Russia rolling into Afghanistan, and that's really what caused the gold price to double within a few months, because the gold price had already ran up from $100 in 1976 to about $400 in late 1979. And then the geopolitical component kicked in once Russia rolled into Afghanistan, and the gold price went from 400 to 850 within about 8 weeks. And that was that ended up being a blow off top. But I digress here. It's basically, you had Powell come out yesterday and poo-poo stagflation. And of course he's going to say that, because that's the last thing that the Fed wants to see. But he was also saying the same thing about inflation in the first place. He was calling it transitory for months. They should have started raising rates well before March of 22, when they did start to raise rates. So how are we expected to believe a man that told us that inflation was transitory as it was running up to 9%? And now he's telling us that there's no fear of stagflation, that we'll be able to get it down to our 2% target, while at the same time he was chastising government for their fiscal problems of continuing to issue debt to buy the old debt. It's a Ponzi scheme. And that's what the gold price has figured out. That's what the market has figured out, that the Fed is stuck. I mean, back in the 70s, our national debt was moving in on $1 trillion, and the debt to GDP was 35%. Now we create $1 trillion of debt every 100 days, and we have to reprice this debt at higher rates, and it's a Ponzi scheme, and it continues to go higher. The debt is going to be over 35 trillion by the end of the year, and there's no end in sight. It's a debt spiral.
No, 100%. I fully agree. And the question is, like, how do you break that cycle? Right. That's I think the number one question. I don't think anybody really has an answer for it. Like,
Exactly.
The only answer really is, like, the logical one would be default, but nobody sees that happening. So.
Yes, exactly. The dollar is still the world's reserve currency, and they continue to berate that privilege, right? They continue to take advantage of it. Most of the dollars are held overseas. Everybody needs dollars to pay off the debt that's denominated in dollars, and the United States takes advantage of that. And they continue to fund war. Another $100 billion to fund wars in Ukraine and Israel. And then what's going to happen when China finally just says, "Hey, it looks like a good time to go into Taiwan," with the U.S. having their hands tied in fighting a war in Ukraine? That's a losing battle, and then giving Israel more money. So it's only a matter of time to where the gold price finally ends this consolidation and goes up towards its next target, which is $3,000 an ounce.
I might use that for a YouTube title. Next target, $3,000. But let's not get irritated by that. But Dave, like, last macro question I have for you: if you were in
Okay.
Jerome Powell's shoes, what would you do?
Wow. That's a great. First of all, I wouldn't have taken the job. I don't envy him that position.
Well, he's only making $180,000 a year, so I'm not sure how interesting that is.
Well, if you take a look at previous Fed governor stock transactions, I think they're making more than that. But I digress.
I was going to say we're going to talk about your mining transactions, how much you made in mining in a minute here as well. But all jokes aside, like, if you were Jerome Powell, what would you do?
I do exactly what he's doing. You know, he just continues to jawbone in inflation, saying we're going to keep trying to get it below its 2%, below the 2% target, which is, you know, impossible because they can't control what's making inflation, what's keeping inflation sticky, which is, you know, funding of these wars and the balance sheet, and there's just no fiscal restraint in Washington. They can't control that. And it's funny, he came out in public and basically chastised his boss, the U.S. government, on a 60 Minutes interview. I was blown away by that. So I mean, I think he's doing a pretty good job, you know, considering the mess that he's inherited.
No, fantastic. I think we can put a bow around the macro discussion here. I think we've set the scene. Next target is $3,000 for gold. The question is now, how do we play that as mining investors? It's been absolutely dire over the last 2 years. You know, maybe I think my camera cable keeps resetting, so I do apologize for the freeze frames here and there. But Dave, before we actually talk to miners, I think you should run us a bit through your investment philosophy, since you haven't been on in like 2 years. Run us a bit through how you're investing, what you're looking for, and where do you generate your returns?
Yeah, well, I've pretty much left alone the exploration side of the market. You know, early stage explorers, any company that doesn't have at least a PEA with a defined resource that shows a high margin project contained inside of a district scale package that's run by a serially successful management team that understands how to maneuver these very treacherous capital markets while still having a decent share structure at the same time. Those companies are becoming fewer and fewer. So those are the companies I like to concentrate on. So basically late stage developers that have all those attributes, and growth-oriented producers, small cap growth-oriented producers under $1 billion market cap that I see exponential growth within the company.
Okay. I just wrote down a question, and I'm going to ask you that later because I think it fits in better when we're talking maybe about the micro end of the market. But I want to start at the top. Like, I want to start with the Newmonts, the Barricks, and the Agnicos. We've just seen the Q1 reports come out, the Q1 financials, and I'm curious, like, what did you see? Like, what trends do you see emerging, and are they generating more free cash flow here?
Absolutely, yes. And to preface this, I own both Agnico and Newmont in my my SEP IRA account, my retirement account. But something very interesting happened last week in the Newmont report. You know, that was the first quarter where they had the combined assets with Newcrest, and they reported a blowout quarter, and they reported the fact that investors needed to be reminded of what's happening right now. Is the gold price is finally outrunning inflation, and that means that these majors and midsters, these miners, are basically showing that the margin compression is becoming a thing of the past. So what happened, as you know, the last 4 years was the margin compression has killed the mining sector. I mean, they've done a great job of keeping their balance sheets healthy, and you know, producing dividends for their shareholders and announcing share buybacks. But at the same time, they weren't making as much money because of margin compression. Well, when you saw Newmont's quarter come out showing that they made lots of free cash flow, and that margin compression is becoming a thing of the past, the stock went up 12.5% on a day that the stock market was down a couple of percentage points. So you had Newmont, the only gold miner on the S&P 500, up 12.5% as the stock market is rolling over. It also produced a breakout of its downtrend. So what is happening to Newmont is very important for the rest of the sector because it's the general, right? It's the world's largest gold miner by far now. It produces twice as much gold as Agnico Eagle, which is now the number 2, who's replaced Barrick as number 2. So if the general is not moving forward and continues to go down, then why would anybody invest in juniors if you're a generalist? So Newmont breaking its downtrend is very important. And it's coming back to test that breakout right now as I speak on lower volume. Like that's what's happening in the gold sector, right? You've seen the gold price is consolidating its move that happened on rising volume on lower volume. So that's a consolidation. And the same thing is happening in Newmont, which is the general in the gold sector, mining sector.
Operationally, how does Newmont perform versus like a Barrick or an Agnico? Like, is there big differences? Do you see them outperforming, underperforming, or like how are all three performing right now if you were to mix them together?
I see them concentrating now on higher margin projects. See that they're divesting, I think, 6 mines, and they're concentrating on their top tier mines that are high margin. So they've got they've got over $3 billion in cash. And they've got a share buyback program going. And the last time they did a major share buyback program was when they took over Goldcorp, and that worked. They took over Goldcorp at the bottom of a cycle, and then once that merger was brought into the company, the stock took off at the same time that they announced that share buyback program. So I think there's a really chance of this happening again because the stock topped around 80 in early 2022, and the gold price was double topping at the time at 2000. So Newmont has a lot of catching up to do. I know there's been some dilution in there because of the merger, but it's got a very solid balance sheet. And they've got top tier gold mines in safe jurisdictions. So I really like Newmont, and I really like Agnico because if you take a look at what happened with Agnico, they announced a blowout quarter right after Newmont did, and their margins actually went even higher because their all-in costs went down as the gold price went up.
Well, that I haven't seen actually costs coming down, and Agnico seems to be managing that really well because they have Canadian assets mostly, like in tier 1 jurisdictions. And I looked up the Newmont all-in sustaining costs, actually $1,439, which are really high, for all the majors. And that's what you mean. Like, I think we need to explain that margin compression just a little bit. I've been mentioning it in other interviews, but when gold was trading at $1,300, Newmont was producing maybe $750 all in. So let's assume $550. But when gold was trading at $1,750, their all-in costs were $1,250, right? So those costs, as you said, outpaced the gold price developments, and that is reversing. I think is a really, really important trend, Dave.
Absolutely, yes.
So, I think we've said that on the majors. Like the only question I have now is like, do you see more M&A happening? I think your guess is as good as mine, but I still have to ask, like, what are they going to do with the free cash flow? I've seen Barrick announce a quarterly dividend. Personally, I don't give a crap about quarterly dividends, quite honestly. I want to see share price appreciations, and ideally they buy my junior. But
right.
Where do you stand on that? Like, do you like dividends? Are you more growth or more value oriented?
No, I'm with you, but in a point that you mentioned there, of course I want them to buy my junior, but at a lot higher prices, right? We don't want to take under, which we continue to see a lot of these take unders, which need to happen. I mean, any merger is a good merger in this sector right now because a lot of these companies, there's too many companies and there's too few capital to fund them, as you know. So a lot of these companies still need to go away. There has been some positive mergers. The recent Reunion G Mining merger, that's positive, and I think there's probably a good chance that we might see a bidding war for Reunion. That's one of the best projects out there. So we had another take under also. We had Silvercorp who lost out on their bidding war for OreCorp. Took over Adventus, and they're moving into Ecuador. But a lot of many people don't like to invest in a Silvercorp because of the Chinese risk. So But we do need to see more of this M&A, and I think we're going to continue to see it because the gold price is breaking out. We now have a solid floor at 2,100, which used to be strong resistance. I think that a lot of investors and even the miners also are waiting to see what the result of this consolidation is going to be. Will it come back to test that 2,100, 2,150 area, that breakout area before continuing higher? I don't believe so. But anything can happen in this space. I've learned to never be surprised by the gold market and what takes place.
Absolutely. No, I fully agree there, Dave. The big majors, like you brought up Newmont and Newcrest, that merger is just still being digested, but quite a few projects are on the chopping block, as you mentioned. Like, do you see that happening? Who's going to buy coffee, for example? And who will pick that up? Are we going to see new mid-tiers being created, or is it just going to be a major picking it up, maybe a junior making a leap? What are your thoughts on that? What are you seeing?
Yeah, something like coffee, I don't see a major taking. Maybe a mid-tier will take it, but yeah, I mean, any kind of merger, any kind of M&A activity is good. But what I also want to see, Kai, is I want to see more strategic investments in these juniors. We're starting to see it. We've seen a couple recently, but I want to see more of that because because a lot of these companies, what they need is they need to see that. Investors need to see that they have that access to capital to build the mine, right? Because a lot of these companies have gone down, their market cap have gone so low, they need to raise 2, 3, 4 times their market cap to build the mine. So investors want to see the access to capital. Investors want to see a credible timeline to being shovel ready and fully permitted. They want to see these things before they invest their money. I think that a lot of these mergers and acquisitions are going to start to pick up once the gold price has shown that it's bottomed at a certain point and starts to move towards that next $3,000 target. So it needs to get back over 2,500 first. And this healthy consolidation is, like I said, it is healthy and it needs to take place, and it's happening at a high level. And what you're starting to see also is you're starting to see the gold stocks outperform gold for the first time in quite some time. The gold price has come off 5%, and yet the mining sector has only come off 5%. So, the leverage is there in the upside and the downside in the miners, and the miners now are showing that they're starting to catch up.
No, and that's exactly what we want to see. Like, people are starting to understand what is happening. We have the big billionaires like Stanley Druckenmiller talking openly about acquiring gold and gold stocks. We need that type of publicity, right? So we need those mainstream media headlines to sort of push us to the next stage. Because I mentioned it in a couple of other interviews. We're still not seeing the generalist investor coming downstream, downstream, down to the juniors, right? Like, the juniors are still lacking. And before we hit the record button, we briefly talked about the bifurcation in the market and where the funds are flowing. And I think your investment philosophy covers that perfectly, right? You're only looking at later stage development companies that might have already generated a PEA. So the question I wrote down earlier that I hinted at, I was going to ask you, like, what would it take to bring you down earlier stage again, Dave?
It's going to take the financing window opening a lot wider. As you know, it's got a little crack right now. The capital markets are being very, very selective, and we're seeing a lot of these early stage exploration companies just keep the lights on money. So I want to see big financings in earlier stage companies, with preferably even without a warrant. That's highly unlikely giving their early stage, but I want to see big money being put into some of these early stage companies.
It's still not there. Like the Ornick index, we're still, like, our 5-week moving average is still around 50, which is not bad. Don't get me wrong. I think we'll have a solid and healthy financial year, money raising wise, but it's not going to be frothy. Like, we're far from frothy. If you look at the 100 level that of that index, it was set back in January 2011. So it's a bit maybe an unfair comparison. We're doing much better, but we're still far from those levels. We need to get back to those. Absolutely. Dave, like, there's a few more things I want to talk to you about. Like, we've talked extensively about gold, obviously, as it is the main focus. It attracts the most capital. How about silver? It's still trailing gold, and to performance-wise, yes, it's up slightly above gold, maybe 30% versus 25%, but it should be 75%, based on history. Like, why are we lacking, and why hasn't silver broken out?
Yeah,
It hasn't broken through $30.
we had a little excitement generated there because we saw silver run up to 30 on the back of geopolitical news. So the geopolitical component kicked into silver. That was nice to see, but $30 again became, and that's multi-year stiff resistance. And once gold got over 26 was resistance for a couple years, and now it's come back to test 26. I think this morning there's an open gap there at 26. I think it might have been filled this morning in the futures market, but that's now bouncing from there. So we had a retest of the breakout above 26. But if you look at the silver stocks, and you're seeing a lot of bifurcation. You're seeing a lot of bifurcation in the silver stocks because, let's face it, there's really not a lot of silver related stocks that are investable, especially in the juniors. So you have to be very selective. But there's still a lot of upside to be had in these silver juniors. You just have to be in the right ones. But as far as the silver price is concerned, we need to get over 30. So what we need to see to get the bull market really going in the mining sector, you need to see $30 ceiling in silver become a floor, and you need to see that gold silver ratio trending below 80. 80's been the number to watch on that gold to silver ratio. Each time it gets there, it goes right back up again, and silver starts to lag gold again. So we need to see both of those things, because if you take a look at GDX, GDXJ, and the silver price, they're almost mirrored in their stock charts. So we need to see $30 in silver become a floor.
Now, you brought up the GDX, GDXJ, and the HUI. I'll throw in there as well. And I've been making comments, and I'm almost annoyed by it. But on a 12-month basis, we're still down, despite the massive rally in precious metals prices.
Right. Still haven't made a 52-week high in GDX and GDXJ yet. They attempted to the last week, but we're seeing them both sharply hammer in the last 2 weeks. We have strong, sharp, bullish hammers in the last 2 weeks off 40 in GDXJ and 3250 in GDX. Those were pretty strong resistance for the past year and a half or so, and now they're trying to become support. Right now, it's trying to produce a third bullish weekly hammer off those levels as we speak right now, going into the jobs report tomorrow.
Let's talk. We talked about the economy and the state of the economy. Shrinking economy is usually not good for the copper price. So I'm curious, why is copper price rallying right now? We're trading over $4.60 a pound, over $10,000 a ton. What's been driving copper prices?
I think it's a few smelters in China were shut down. I think that's a big reason. And silver, copper, I think needs to get above $5, and $4 needs to be a solid floor in copper. But people are starting. Investors are figuring out the fact that, hey, we need to replace all these old copper mines that are being depleted. And what is it? One Bingham Canyon needs to be replaced every year or something. I don't know what the figures. I'm not as well studied on copper as I am in gold and silver, but I do follow copper, and I do have several copper juniors in my portfolio. But we need to see the copper price get above $5, I think.
No, there are not too many copper juniors out there.
No.
I played a game with a friend of mine the other day that I saw on a site visit, and it was like, how many copper mid-tier companies can you name? And that is a challenge. Like, think of it. It takes some thinking. It's not one of those snap reactions.
Right. Exactly. Exactly. That's why I like it. But you got to be very selective and very careful, because it's like uranium. There's not a lot of uranium juniors out there, and if you pick the wrong one, then you're going to get killed.
Well, there's 10, I think. So just on copper real quick, Dave, I wanted to ask you about uranium. We'll get to it in a second, but just on copper, BHP announced that they want to buy Anglo American. What is the signal there? Like, how can we interpret that?
That's huge. That would be the biggest mining deal maybe ever. It's huge. And Agnico Anglo came out immediately and said, no, that's too cheap. And then a report came out. This is the price. This is the fair price. And if the deal gets done or it doesn't, I think it matters more if it does, but it brings a spotlight onto the sector, which is what we need. We need to see more eyes on the mining sector, because if you take a look at the mining sector, how small it is in relation to the rest of the market. I mean, what is it? 1%, is in relation to the rest of the market. I mean, that's a century low. I mean, nobody cares about mining, right? I mean, and that's why we're continuing to hold, and we continue to have optimism, because we know that's going to change. It's the timing, right? We don't know when that time is going to happen. And we thought it was going to be when the gold price finally broke out above 2,100. But it looks like that maybe gold price needs to break out above 2,500 before we get more generalist eyes on our sector.
Well, I was going to say, I love how we're moving the goalposts. Like I can remember doing interviews like, oh, gold's just got to go above $2,000 and we'll be hunky-dory, right? And then everybody will have 10 baggers in their portfolio.
Right.
No. So now we're saying 2,500. It's interesting because it's really tough to time. You don't know what the trigger will be. Like,
so difficult.
Why don't the generalists believe? Right.
Exactly. So, and that's why you have to accumulate a basket of these juniors if you want to play. And, with a lot of them that you accumulate for a while, you have to make sure that they don't dilute your upside too much. Right. Because there's a few companies that I own that I started getting into them when they had 10 times upside. Now, maybe they only have 3 or 4 or 5 times upside, which is okay. But we get into these things because they're high risk, high reward, right? We want the multi-baggers, because it makes up for the mistakes that we made in picking some other ones, because it's basically like a batter in baseball, right? If you get 3 out of 10, you're doing pretty good. And that's the way you have to look at your portfolio and in your junior portfolio and your returns and your wins and your losses. And but that's what makes this sector so exciting and so fun, right? Because it is such a challenge. If you can beat the junior sector, you feel like you're the king of the world. You could beat almost anything, because it's a very challenging and difficult sector to master.
Tell me about it. I've been in it for 15 years. I still haven't figured it out. Dave, I have 2 more questions for you.
20 for me.
So 20. Oh, I feel bad for you.
It's getting grayer.
But you're still only like, what is it, 39? So yeah.
60, pal.
No, Dave, 2 questions. One is a philosophical one, and then of course I mentioned we need to talk uranium. But maybe we'll start with a philosophical one. Is do you rather take in dilution, or do you want to see the companies like be stagnant? Meaning, like, maybe I'll give an example by what I mean. Fireweed Zinc or Fireweed Metals took in the Lundins and other big shareholders, but they had to dilute by 40%. But now they're in a decent position of growth and they can expand and explore. Mm-hmm. But dilution was an issue. So the question is, like, where do you stand on the topic of dilution versus value creation?
Well, it all depends on where the money comes from, right? If it's a strategic, if it's a major, if it's a minor, if it's a strong partner, if it's a strong mine builder, then that's a positive finance, and the stock is going to take off on a positive finance. But if it's just a lower number, and it's just mostly retail, and the book is not strong, then it's going to be seen as a desperate move, and the stock is going to go lower. That's really what you need to look at, is where the money's coming from. How strong are those shareholders that are coming in, and are they going to be beneficial to the project evidently eventually being built?
No, strong points, and I fully agree. Like, I personally, I don't mind dilution if it takes me to the next level of development.
Right. Exactly.
Right? Like value creation. Like,
and you got to watch the warrants too, right? If it's a full warrant at like 3 years that they have to give up, then they were desperate, and they had to do a lot of shucking and jiving to attract the capital, right?
Exactly. Well, as an investor, I do want the warrant, but as the company rep, I don't want to give out warrants, right? I'm a director of 2 companies. I'm fighting tooth and nail not to give them out, but sometimes you have to, right? That's what big money says. There's no way around it.
Exactly.
Dave, let's wrap up the conversation. I mentioned we need to talk uranium real quick. I think we're trading at 92.30 a pound again. So maybe reversing that downtrend, maybe that correction phase. Curious what you're thinking about uranium and uranium stocks in general.
Well, that's not my area of expertise anymore. I've kind of shunned the sector for the past several years. I unfortunately I didn't get in on the big move up. I was concentrating on gold and silver and copper. But what I'd like to see is some of that money coming into the gold and silver as the stocks are starting to come off a bit. I mean, you are seeing some M&A in uranium as well. But it's if junior gold and silver and copper stocks are very risky and very volatile, and they're pretty much hugely very risky and very volatile, then uranium stocks are even more so. So that's a higher risk and higher volatility sector that I don't feel comfortable holding stocks for a long period of time. Because what I like to do is I like to see 2, 3, 4, 5 years upside in holding a stock and holding a junior silver, gold or copper stock. And I'd like to feel comfortable holding that for a long period of time. And I don't feel comfortable holding uranium stocks for that long a period of time.
You and I are very similar in that regard. I'm a hodler. I'm a hopeless dreamer and romantic in junior mining.
Yes.
I'm the worst trader, so we definitely have something in common there. And we're both liking, like I look at the long terms. Like I want to build something. Like I want to
exactly.
Like, I'm not a trader. Like I'm not in for a quick flip or even chasing warrants.
Right. I believe in these management teams. I believe in these projects. And like you said at the opening, I invest in these things. I'm investing my hard-earned money along with my subscribers. So I want to see that. I want to see them do well. I want to see them invested in the company. I want to see them participating in financings. I want to see them de-risking the projects in a fiscally sound manner. Managing capital markets is a big one. If you mismanage capital markets, then you're out of the game. I mean, you could be like Serato and end up having to sell your best asset because you mismanage capital markets, right? I mean, and this happens to the best of them. I mean, this is Serato is a fantastic management team. They made me a lot of money with Desert Sun was one of my first big wins in the mining sector when I got into this space 20 years ago. They did a fantastic job with that project. They sold, everybody made money, and they were trying to do it again here with Monte do Carmo, which is, Mark Brennan said himself was one of the best assets he's ever seen. And unfortunately, they're big shareholders and they didn't want to over dilute themselves. So they waited too long and they ended up mismanaging the capital markets. And unfortunately, they had to sell their best asset.
Junior mining is such a fickle beast. There's no winning formula, which is really interesting.
No. And what worked during the last bull market might not work during this bull market, right? I mean, look what happened during the last bull market. Did anybody even care about permitting? No, they didn't. Nobody was saying anything about, okay, how long is it going to take to permit the mine? When are you looking to be shovel ready? Nobody cared. They just wanted ounces, low grade, high grade. They didn't care. Ounces at any price.
Now I remember it's like the narrative is slowly changing because everybody's talking about, $100 ounce in the ground. Now everybody looks at it as like, well, I might sell it for 20.
Yeah. I mean, now the average is what, $30, $40 an ounce in the ground is what these juniors
it's definitely coming down.
Right. And then at the top of the last bull market, you had Redback taken out at $1,000 an ounce in the ground. And then you had the company that owned the Midas project that spun off Pilot Gold. That's now Liberty Gold. Starts with an F. I don't remember the name.
I've been to it. I've been to the mine.
They sold at $1,200 an ounce on the ground. $1,200 an ounce on the ground. And now these things are trading at 30, 40. Some are trading at $5 an ounce. And they have multi-million ounce projects in safe jurisdictions, in a jurisdiction like Idaho. But the NEPA process to get the thing permit takes like 3 years.
Same in Arizona.
Yeah.
Absolutely. Dave, Dave, absolute wonderful conversation. I could keep this going. As you notice, like this is turning more into a discussion now, and I absolutely love it.
Yeah, sorry,
We
I
got to have you out
rambled
here in
on.
Frankfurt at the Deutsche Goldmesse.
Off topic.
Oh, it's a fun topic. Like we both know a lot about it, obviously, and it's fun debating. And again, I do apologize for the camera cutting in and out. I think it's a wonky USB-C cable. But Dave, you got to come out to Germany. You got to join me here at the Westin Grand next time.
Oh yeah, if you do it during the summer, my wife and kid could come with me. I'm there.
Maybe over Thanksgiving next time.
Yeah, maybe.
We did it over Thanksgiving last year, so I have to look at the dates for 2025. And Dave, where can we follow your work? Where can we find more?
Every week I put out a weekly column for Kitco. It's kitco.com. And you could find me on my website, Junior Miner Junky with a Y.com.
Phenomenal. Dave, like I really enjoyed this conversation. It's been way overdue. It's too long since we've properly chatted. And I can't wait to see you again. Hopefully it may be precious metals in September.
Me too, Kai. Thanks again.
Looking forward to it.
Always a pleasure.
And everybody else, thank you so much for tuning in. Really enjoyed this discussion with Dave Erfle. I've known him for a number of years. Great sounding board. He does a fantastic job on the mining side. And as I said, like he invests his own money. That really separates him. So he looks at things very differently because he can't afford to lose money. Quite honestly, who can? And maybe it adds an extra, step of due diligence, which is really important. And as you've noticed, he understands the macro picture as well. He sees where things are headed. He's adjusted his investment principles accordingly, moved later stage. And as you've heard, I've asked him, what does it take to come back to the juniors? Well, more money in the market. We need the generalists investing in the junior stocks, more placements, more private placement, or money flowing into private placements. If you enjoyed this discussion, please do us a huge favor, hit that subscribe button, leave a comment, leave a like. Where are you investing? How do you see things going? Obviously, gold next target, according to Dave, is $3,000. And numbers, like I've said in another conversation, sounded absurd and crazy not even 12 months ago when people mentioned it. Now it seems the norm. Even Citibank raised their price target for gold to that level. And that seems to be the new normal. And I'm excited about it, what it will do to the junior mining stocks or the mining stocks in general. Follow us for more. We really appreciate you tuning in, and we'll be back. Thank you so much here from Frankfurt, from the Deutsche Goldmesse.